What if the place you keep your money safest is actually the place where it grows the least? Most people keep their cash sitting in a bank savings account because it feels safe. But here's the question. Is your money actually growing or slowly losing value? Today, we're breaking down bank savings versus investing. The real differences, the risks, the rewards, and which option could help your money grow faster. What is bank savings? A savings account is basically a place to store your money while earning a small amount of interest. Simple, safe, easy access. If you put $1,000 into a savings account, your bank might pay you around 1% to 4% interest, depending on your country and the current market. Sounds good, right? Well, not always. Here's the hidden problem. Inflation. Inflation means the cost of things like groceries, gas, rent, and coffee keeps rising over time. If your savings account earns 2%, but inflation is 3% or 4%, your money is actually losing purchasing power. Your balance may look bigger, but what your money can buy becomes smaller. That's why many people use savings accounts mainly for emergency funds, short-term goals, bills, and everyday cash access, not long-term wealth building. What is investing? Investing means putting your money into assets that have the potential to grow over time. This can include stocks, ETFs, or index funds, bonds, real estate, retirement accounts. Unlike savings accounts, investing comes with risk. Your money can go up, and yes, sometimes it can go down. But here's why people still invest. Because historically, investments have often produced higher long-term returns than traditional savings accounts. For example, if you invest $5,000 and it earns an average annual return of around 7%, that money could potentially double over time through something called compound growth. Compound growth is when your earnings start earning their own earnings. Think of it like a snowball rolling downhill. It starts small, but grows bigger and faster over time. That's one reason investing is popular for retirement planning, building long-term wealth, financial independence, savings versus investing. Which one wins? The truth is, they serve different purposes. Choose bank savings if you need quick access to your money. You're building an emergency fund. You're saving for something short-term, like a vacation, car repair, or upcoming expense. Choose investing if your goal is long-term growth. You can leave your money untouched for years. You want a better chance of beating inflation. Here's an easy way to think about it. Savings protect your money. Investing grows your money. Smart money management usually involves both. Many financial experts suggest having an emergency savings fund first, then investing extra money for long-term goals. If you're just getting started, here's a simple beginner strategy. Step 1. Build an emergency fund. Aim for 3 to 6 months of essential expenses in a savings account. Step 2. Pay attention to high-interest debt, because debt can eat away at your financial progress. Step 3. Start investing gradually. You don't need thousands of dollars. Many platforms today allow beginners to start with small amounts. Consistency often matters more than starting big. The earlier you start, the more time your money has to work for you. So where does your money really grow? Savings accounts offer security. Investing offers growth potential. The real key isn't choosing one or the other. It's understanding when to use each one. Now I want to hear from you. Are you more of a saver or an investor? Drop your answer in the comments below. If you found this video helpful, hit like, subscribe, and turn on notifications for more beginner-friendly money tips.